Welcome all to the Node. I am Mike, aka Veteran Crypto, and this is your place for news, interviews, and DeFi and crypto education. So, with that, we're going to go ahead and jump right in the news. But I want to, you see, sorry, a little bit. All right, here we go. So, this is our official website and newsletter. Hey, how's it going, David?
Good. What's up, Mike?
Oh, nothing. I was just while we were doing the intro, I was reading a message. I found a gentleman that I've watched some of his content. His name is Crux. He's a veteran as well, and he does a lot of content on Kita. It was very respectful. Reached out and said that he would love to come on the show. He has his own channel and stuff like that. He's been a guest on a couple other shows, and I was able to. Basically told him that we were looking for somebody to come on and give us a good solid rundown of and I've watched some of his content, and he's very good at citing his sources, and actually doing it the right way. So I'm gonna chat with him a little bit, but I think that we might have him on next week, and be a little bit of a debate, but more so just, hey, show us what and show us where again, your cited sources, and what that's what we want to go off of. We want to go off of facts, not not guesswork. And that's the problem that I found with Kita, is just that there's a lot of things that tie the head of Kita, a lot of things that he says are going to happen, and there's a lot of people guessing on what could happen. But a lot of it, as far as the tokenomics and the way that the tokenomics work and the mechanics work, a lot of it is very vague in the official documentation. I really had to dig to find a lot of the information that I did find. But I want to give him a chance. I want to keep an open mind.
I love it. Yeah, let's do it. That'd be great.
So I'm gonna work on that and see what time works for him. He's East Coast like you are, so I told him it's noon to 2. But we'll work on having him on and let him hopefully educate us, and show us where we were wrong about some stuff.
I would love to be proven wrong. Show me exhibit A, B, and C. Let's see some evidence. And by the way, Mike, when you're taking a look at the Node newsletter here, you see where it says next to the Node universe, it says NU. That's going to tell you the generation date and time. So if you hit regenerate there, it's going to give you, because that's from the 17th. So if you hit regenerate, it should give you, the updated snapshot, which is from the 19th a.m.
All right. It's I just barely generated it right before we went live.
Oh, maybe it's broken again.
We'll give it one more shot.
It could very well be broken again.
Well, we'll dip into this.
Let's see what happens.
Yeah, we'll check back on it here in a minute. Let's get into the news. So it looks like the CFTC and SEC seek comment on defining swaps, as the CME sues the CFTC over the same question. We talked about this yesterday, with Kalshi and the perpetuals and all that. This is what we're talking about when it comes to legislation. This is, we need clarity. The only way that, this technology and its use, to update the financial system, is there is going to have to be clarity. Definitions. It's kind of why I'm so big on, before having a serious conversation about something or debate about something, you have to have a foundation of the definition of words, because otherwise, if you start to get into what I feel this this word means, and you can't have a serious debate if you can't agree on the basic definitions of words. It's why it's so slippery. I used it when me and David were joking around the other day. The definition of a woman. If you can't agree on what exactly a woman is, scientifically, it's the right chromosomes, and they can potentially have the parts to have a baby. There has to be a certain basis, because otherwise it's just like, oh, I feel like a woman. It's just like, okay, it doesn't make you one. But it's the same thing with crypto. You know,
Yeah, a woman is a female, an adult female. Like that's it's
no, yeah,
simple.
but it's
Yeah.
the same thing with crypto. You know, it's if we have to know, you know, what a swap is. You know, what does the regulatory bodies define as a swap? If institutions are going to get into this, you know, for me and you know, if we want decentralized, we want, you know, self sovereignty. Yeah, a lot of this regulation stuff we really don't care. But you know,
Right.
if
Code is law. Code is
but
law.
but if we're investing in the future financial system, that's going to be regulated. That's going to, you know, depend on the, you know, this clarity. Then, you know, this is what they need. You know, if we want to tap into that liquidity, if we want to tap into that volume and have a part in those fees and, you know, us as investors and potentially the tokenomics, you know, if the tokenomics are right to where there's value capture, to where, you know, price goes up on our tokens, we have to understand the role that this stuff plays in that. So, David, what are your thoughts on that?
Yeah, well, I mean, what are they saying that the definition of a future is? Like, what are they saying the definitions are right now? That's the I'm curious. Like, so, Mike, what are they saying? The definition of a swap is? What's the definition of a futures contract? Like in DeFi and crypto, what are these proposed definitions? I don't know what they are.
Oh, you're talking about like security based swaps and stuff like that?
Yeah, like what is the CFTC saying that the current definitions are?
So let's read a little bit about it. So it says joint request for comment. Um, let's see.
Yeah, by the CME. So they got sued by the CME,
Yeah,
and the current CFTC definitions of a future and of a swap. So we've got statutory definitions. Okay, let's just take a look at this here. That definitely is going to be a point of contention. And I think that it's going to be, you know, this is what we were talking about, Mike, over the last couple of months here with this, you know, Clarity Act and Genius Act.
yeah.
You know, these two pieces of legislation together, they're not going to be enough. It's still going to take years and years and court battles for there to be precedent set and for there to be real, true clarity. So I'm happy that the CME is suing because that will give the court system time to, you know, set precedent here. And that way, you know, everyone knows what the ground rules are moving forward. So I'm happy it's happening now. And, you know, let's see. So a future, that's a contract for future delivery. So let's see here. Historically, a futures contract is structured as a legally binding agreement to buy or sell a standardized quantity of a commodity at a fixed expiration date in the future, which is settled either via physical delivery or cash settlement on that specific date. So that's a future contract. A swap, apparently, the Dodd-Frank Act broadens this significantly. A swap is defined as any agreement, contract, or transaction that provides for a periodic exchange of payments based on the value of an underlying asset or index, or transferring financial risk between parties without a fixed termination or expiration structure, requiring the physical delivery of an underlying commodity. That is definitely not what a swap is in crypto, in DeFi. And even the futures contract, like in crypto and DeFi, that futures contract definition doesn't apply. There's no, you know, there's no physical delivery. You know, like if you're trading perps, there's no expiration, number one, and there's no physical delivery, number two. And if you're swapping, there is no periodic exchange of payments. You know, basically taking asset A, depositing it in a liquidity pool or on some type of exchange, and immediately withdrawing asset B according to the AMM. So according to the automated market maker logic. So futures, perpetual futures, and token swaps in DeFi are fundamentally different from what the CME is the exchange for, like TradFi swaps, TradFi futures. So yeah, big difference here. And
and that's important to understand, is that there's and it's something that me and you ran into when we were talking about revenue. It's these new assets, they aren't modeled the same. It's what's even something as simple as how you define revenue on some of these DeFi protocols. We had to I had to do a bunch of research. You had to do a bunch of research, and finally we came to a consensus to where you had to start using top line when it comes to an aspect of it, and then revenue is what's left after people in DeFi that provide liquidity, like on Arrow and stuff like that. And
even that, I would disagree even with that. I don't think that the fees generated as a result of a swap in a liquidity pool on Aerodrome or any of the V3 dexes, I don't think that that's protocol revenue. The fees generated.
Again, you're right. That's what we decided the other day. Is that's called top line.
I don't even think that's what it is. I don't think it's top line revenue either.
It's 100% is.
I don't think so. I think it's a fee.
That is all the monies that is generated by the protocol is the top line, and then the revenue is minus the fees that are paid out to liquidity providers that the protocol keeps.
I'll concede. I concede that point. Yeah.
So that's exactly what it is, based off of everything, the multiple sources that I was able to find. But strategy halts STRC share sales that fund its Bitcoin buys as Sailor's flywheel stalls.
It doesn't just stall; it's like running into a brick wall.
Yeah. So strategy pauses ATM program it uses to issue STRC preferred shares after the stock hit an intraday low of $82.50 and closed at $88.59 on a record volume, stalling Saylor's Bitcoin flywheel as community scrutiny grew over his comment that he designed the instrument with AI.
Yeah, dude, he said that he designed it with like ChatGPT or something.
Really?
Yeah.
Oh, shit.
I know.
Strategy paused at the market program through which it issues STRC preferred shares after the security sank well below the 100 level it was engineered to hold, switching off the capital raising mechanism at the center of Michael Saylor's Bitcoin strategy. The pause is the consequential development. STRC, formerly the variable rate Series A perpetual stretch preferred stock, is designed to trade around par through a variable dividend, currently about 13%, and adjusted monthly when the stock trades above $100. Strategy issues new shares and uses the proceeds to buy Bitcoin, a self-reinforcing flywheel. Below par, issuing shares means raising capital at an effective loss, so the machine seizes up. On Thursday, STRC fell to an intraday low of $82.50 before closing at $88.59, according to Yahoo Finance, on one of its highest volume sessions on record, roughly 10.7 million shares versus a typical 3.4 million, and the longest stretch the security has spent below the $90 level at which it debuted in July of 2025. So, what are you seeing as far as this? And do you see that this is fundamentally going to make this break down and the kind of the Ponzi scheme to unravel? Or
probably not. I think that Saylor's got plenty of Bitcoin, plenty of assets to be able to pay these dividends forever. So I think that people are kind of freaking out about it, just because Bitcoin's down what is it, 50% from its all-time high. that's like well within normal standard deviations from a high. Like it's totally normal for Bitcoin to draw down by that amount.
I mean,
It's
it's no rule for Bitcoin, but I mean, and you would know better than I would. I mean, what do you think? Who are the major investors in his stock? That are wanting to earn that 13%. I mean, is it crypto investors that understand that, or is it TradFi that is using it, in some strategy or something like that? And when they see that this happening and they understand that his flywheel might break down, it's too risky for them, and they start selling their STRC.
so I don't have the evidence to prove this, Mike, but I think that the biggest holder of actually be a DeFi protocol. I don't have the evidence to prove it. I'm sure that we could find out. STRC is regulated, so we can find out who holds the thing. But I think it's a DeFi protocol, bro. I think it's like this DeFi protocol called APYX. I'm pretty sure that they hold like some 9-figure position of
Really?
Stretch and SATA. Yeah. And so I think that's part of the reason why, if you like take a look over on Pendle, like if you've got the cojones right now, you can step in and make a solid 150%, for the next 138 days, leveraging up this these PTs, these APYX PTs over on.
You want to show that real quick?
Sure. Yeah, let's take a look, man. This is
valuable for the viewer.
Oh, for sure. If we're talking about like a legit opportunity that you can hop on right now and take advantage of, this is it, man. This is a exploitable opportunity right now. So check this out. Why is this so good? Well, if you're earning, and let's just zoom out here to the daily, and what is it that we're looking at here? So we're looking at a chart of the fixed APY that you earn when you swap in to the PT, this APY USD PT. So a PT is a zero coupon bond, and it's got 138 days until maturity. So if you swap into this thing, you're going to earn 14.02% fixed for the next 138 days. That's great, right? But what if you can borrow against this and then use what you borrow to buy more of the PT? Well, that's called leverage. This is called interest rate arbitrage. And if you hop on over here to Morpho, it looks like you can supply that PT, and then you can borrow this is, so APY USD, I believe that's the senior, or no, that's the junior tranche, and APX USD is the senior tranche. So you can either borrow USDC against the junior tranche and loop it up to do 88. And let me just zoom in so everyone can see this. You can loop it up to do 88% if you borrow USDC on Morpho. Or if you borrow APX USD, you can loop it up and do 150%. So that's only if these borrow rates remain where they are. So that's the risk when you're engaging in interest rate arbitrage, because you know what you're earning on your collateral. Your collateral, you're earning 14% on. Your borrow is variable. If you're borrowing at 2%, okay, great. But if all of a sudden, that variable borrow goes up, well, then your APY that you're earning is going to go down because your collateral APY is fixed. So you know what? I think it's probably a good idea for us actually to take a look at these markets on Morpho. I mean, dude, this is fucking amazing. This is such a great borrow rate. What's the liquidity here? Like, this is a great play. So total liquidity, wow. I mean, look, you could go in with some size into this thing. So, if we just take a look, let's see what this could look like. This is the market. Let's say 1,000. So that's only $800. 10,000. It's a little bit larger. And the borrow, let's say that I want to do max borrow. It's not going to let me select it. Okay, so I need to figure out how do I get to the Oh, there is no multiply because there. So here's the here's one of the challenges with running this play. You have to do this manually because the only place where you can swap into and out of PTs prior to maturity and at or after maturity is Pendle's AMM. You can't swap in or out on Morpho. So what that means is you have to manually loop. So you've got to go in here and you've got to, supply however many PTs, and then you would have to borrow.
What is that website that does the auto looping?
Contango.
Oh, that's
that
right.
Would actually, that would actually not be a bad play. Contango. See, I have to turn my VPN on to take a look at Contango, but there was some problem with Contango. I remember, I don't recall exactly what happened, but there was some issue. You see this here with their TVL falling off a cliff like this?
Yeah.
I don't remember exactly what it was, but I remember we were talking about it a long time ago, like a couple of months ago.
I was, for some reason, I was thinking that Contango was kind of like VFAT, to where they weren't using their pools, that it was just basically a user interface to automate like Pendle and Morpho.
Yeah, basically. Yep.
Okay.
Yep. It's basically like an automated liquidity manager for money markets. But the basic math here is solid. Like if you supply your collateral earning 14% and you borrow at a variable rate, but if you borrow at 1.4%, you're earning like a 12.5 point spread. And then the LTV here, like, dude, this is really high. The max LTV has to be something like 87% because the liquidation LTV is 91.5%. So if I scroll down, what is the max LTV here? So the max LTV, target utilization, where's the LTV? It's got to be, something like 87%. That means you can probably run like what, 7x leverage or something like that on this. So if you've got a 12.5 point spread and you're doing 7x, I think you can actually run more leverage than that. But it shouldn't be all that hard to get up, to like 75% APY. And that's without running max leverage. Over here on Pendle, it's saying that if you run, it says the max LTV is 91.5, but I think that's wrong. That's the liquidation LTV. So, but man, like, I don't think you can do 150% here, but I think you can do 75%. So like 75%, if you believe that Mr. Saylor's product stretch here will not blow up and go to zero, well then, hey, I like 75%, not a bad play.
Yeah, no, I mean that's freaking awesome. And you said that's for the next 100 and how many days?
38.
Well, only 38.
138. No, 138. Okay. Yeah.
So I mean that's like over 4 fucking months.
Yeah, 138. That's pretty legit. I'm thinking that stretch probably over the next couple of months regains its peg. I don't see how this blows up. I think people are, it's a lot ado about nothing. I think that this is just people overreacting to Bitcoin drawing down. Now, Bitcoin likely hasn't put in its bear market trough, although there are some indicators that tell us that we're getting pretty close. One of the best ones, I think, is, and this is a bit of a lagging indicator, but I'll throw it up on the screen anyway, is the weekly RSI. So we're starting to get a little bit of a bullish divergence on the weekly RSI. All that means is the RSI is making higher lows as Bitcoin is making lower lows. So that was what we saw last bear cycle too, which basically marked the start of the end of the bear, where we saw RSI making higher lows and price making lower lows. And that led into the beginning of the next bull. So all that tells me is that we're getting very close to the end of this bear. And if the prophecy holds true, Mike, then, October, man, October.
Yeah.
So, yeah.
Well, I mean, this is kind of a little bit potential bearish news for Ethereum. So Ethereum Foundation loses another key leader as co-executive director. Not gonna, Mrs. Wang.
Xiao Wei Wang.
Yeah, right. So I guess she stepped down as co-executive director and board member of the Ethereum Foundation, the latest of at least 8 senior departures in just 5 months, leaving board member Bastien Ayu to steer the nonprofit amid scrutiny of its governance and rising competition. She left. Exits that have unsettled the organization over the past several months. Her departure follows the earlier resignations, including fellow co-executive director who stepped back after helping steer a leadership transition at the Switzerland-based nonprofit that funds Ethereum's ecosystem development. With both co-executive directors now gone, board member Bastien, who oversaw the transition during Wayne's recent sabbatical, has taken on a larger role guiding the foundation on an interim basis. Looks like Ethereum faces mounting competition from rival blockchains for developers, capital, and users. The repeated turnover at the top has sharpened questions about who is steering Ethereum's long-term strategy and how the foundation should be structured. Wang, who took the co-executive director role last year alongside Stansdak, during what she described as a demanding period for the foundation, said she reached the decision to step down after a sabbatical that gave her time to reflect on her priorities. I've come to feel that this is the right moment for me to step back. She wrote. Vitalik Buterin credited her with a decade of contributions to the ecosystem, citing her work organizing Ethereum's research and consensus efforts and building an active developer community in Taipei. Wang framed Ethereum as resting on its broad base of contributors rather than any one role, writing that the network has always been bigger than any one role, any one organization, or any one moment. So, I mean, do you see this as being, because, I mean, we've reported on Aave and how they, kind of lost their DAO, they lost their risk management team, they lost, their development team, things like that. I mean, do you see this as being, similar to that, or do you just kind of see this as, like some bear market moves to, better align Ethereum with, its way forward?
I think this is bullish because obviously the people at the helm have fucked up. Like, look at Ethereum's price action; it's been horrible.
Yeah,
So like these people are responsible. And I think that the person at the helm now made it pretty clear with the new manifesto that came out that, hey, get on board or get out. That was basically what I took away from that. And, I just found a copy of the Ethereum Foundation mandate. And do you want me to share this shit? Like, what the fuck is this, dude? Like, look at this, dude. This is apparently, according to Gemini, this is a copy of the new Ethereum Foundation mandate.
Dude, why?
So, okay. So let's just, I'm going to try to reserve judgment for the moment, just because I want to learn about it. But at first glance, does not look good. Okay. Now the current leadership is Bastien Au. So that's a person's name. So let's see here. Day-to-day operations being guided by Bastien Au. Aui. Bastien Aui, who stepped into the interim leadership role to steer the organization through its restructuring. Okay. So that's a man. So his stated mission is to keep the organization laser focused on core cypherpunk infrastructure rather than commercial application adoption. So I don't hate that,
I mean, from a self-sovereignty, decentralized, stance that that you're very steadfast in, then that's very bullish.
Yeah, and I'm trying to find a picture of this of this individual here.
Well, I'll do that. You keep going with the manifesto.
Okay, great. Yeah, so here's the manifesto. And they've got all this stupid bullshit in here, like love always finds a way and heartbeat sync. Like, what the fuck are you talking about, dude? We're building an internet computer here. Why is there Lord of the Rings goblins on this shit? Like,
Right?
come on, man. Infinite love. Like, let's get real here, dude.
Yeah.
So, chapters, Ethereum, our role, our mandate, principles for action, carrying out the
Right.
work, resolving quandaries.
Here's
Oh, what happened?
here he is. This is him.
Okay, got it.
This
So he's German or Danish?
Sure.
I don't know. What's the difference, honestly? Like aren't the Danes kind of like German light or something? But,
yeah. At some of their names, I think so.
So if we're taking a look at this manifesto, I've only read like excerpts from this. I haven't read the whole thing, but why don't we just take a look at in closing, like the last page, 37. Let's just read the summary of this. Okay, dude, what in the fuck? Like, dude, like we're talking about like this is supposed to be serious. We're talking about a big protocol, multiple hundreds of billions of dollars, like basically every DApp in DeFi, and you got this stupid shit. What the fuck, man?
It's not just Ethereum. I mean, we've talked about this before, like Plume. They're trying to make themselves to be like the go-to purpose-built RWA tokenization DeFi chain, and they have cartoon birds and shit. If you're trying to be the rails for the future financial system and the tokenization of all things, and
Jesus Christ, dude, look at this shit.
Why are you why are you, it's like you're catering to freaking preteens and shit. It's like, what are you doing?
This looks so retarded. So I got to read this. So this is the conclusion, or where is the conclusion? This is resolving quandaries. So this is not the conclusion, but like I just landed on this, and I got to read this. Over the course of the next 1,000 years, we and our successors will face countless challenges and be confronted with difficult choices whose specific details we cannot anticipate. But human history teaches us that although no two Jesus Christ, bro, what are we even talking about here? Like, what in the world does this have to do with cryptography and Ethereum? And like making it into something that is going to be like a parallel financial rail.
Are we sure this is like an official document from the Ethereum Foundation even?
Bro, Ethereum.foundation/EF mandate.pdf.
It's on their website. Yeah. Like, fuck. I was hoping maybe
this is embarrassing.
Yeah.
Like, no wonder they've left. Okay, let's read the closing arguments. At least they've got, doves on it. Maybe that means like peace or something, I guess. This new agey shit.
Oh, fuck.
Your future is our future, heart emoji. You're wired into Ethereum. Affirm. I love you. Bro.
What?
Purity spiraling upwards. Hacking successful. Synergy amplified. Bro, they must have been on some drugs when they were writing this shit.
They're on mushrooms or something, writing this
shit. LSD, bro. I don't know. Something. Network spiritualized, dude. Bro. Okay, this is the closing statement. Let's just read this here, Mike. So let me zoom in so that we can all take in the beauty and the ephemeral love of this shit. Here we go. 8, closing. This is the Ethereum Foundation mandate, okay? Which, fucking, what's his name again? Mr. Owie. Our work is not about capturing markets, corporates, or states, nor about helping them extract or capture. I can get behind that because a lot of the cypherpunk like ideas are about this. You know, that's okay. That's cool. It says we are here to uncapture the individual and to entrench their freedoms of association. I love that. We are here to provide the infrastructure that enables a voice for those forms of cooperation, organization, and community that go unrecognized within existing hierarchies and systems. Again, this is cypherpunk type language here. Not bad, not a bad thing. We provide the tools and the digital space needed for the civilization scale project, one that is open to anyone willing to claim self-sovereignty with their own hands. Love it. That is available to everyone, especially those with nothing to lose but their barbed wire fences. This is good, man. This is good so far. Okay. Ethereum is so other people can't rug you. There's a lot of people that have been rugged on Ethereum dApps. Yeah. Society can't rug you. Your government can't rug you. Another government can't rug you. Corporations can't rug you. Institutions can't rug you. AI can't rug you. Mountain men can't rug you. What are they talking about with that? Your family can't rug you. And so you don't accidentally rug yourself either. Okay, I get it. Ethereum is all about anti-rugging. Great. Yeah. The foundation exists to prevent Ethereum, or more accurately, the promise of Ethereum, from being rugged, to prevent Ethereum rugging those who are relying on it to build their own sanctuaries, to make sure that it embodies the shared principles from which Ethereum descends, upholding and advancing them rather than letting them down. We have been entrusted with the torch of liberty, and we must keep it burning bright until the time comes to pass it on as it was passed to us. Okay. Ethereum is for far more than crypto. The world computer, okay, so they're calling it a world computer. The world computer must rise and take its rightful place as a shining star in the constellation of technologies that underpin human freedom and flourishing. A lot more than crypto is counting on us to steward Ethereum with skillful intent and discernment. I would agree with that for sure. For we are building nothing less than the machinery of freedom, not just for today, but for the next 1,000 years. Okay? Our goal is to ensure the garden we've grown doesn't just stay alive, but flourishes. The commons it creates remain open and infinitely spacious, and the tools of sovereignty that are built remain available to all who would grasp them, to all who would log on and win forever. There will be times when the work will be thankless, the journey will be arduous, the path will be lonely. But every road to the stars first passes through darkness. A Quindi, a Simo, a river, Lastel. It's got to be Latin. Let me just see. What does that mean in in that ancient, almost dead tongue? Let's see here. I gotta tell Gemini to translate that. Really, translate that to English. It just basically gave me a whole bunch of information about it in Latin. What good is that? So it says, here's the translation. And thence we came forth to re-behold the stars. So I guess depending on the translation, you might also see it as, and so we outed to see again the stars, or, and then we emerged to see the stars once more.
Basically a bunch of nonsense.
Well, basically, like, they couldn't see the stars because they were looking at the ground, and they looked up, they're like, oh, there's fucking stars. Like, so, but like, dude, like, I don't hate this though. They use some words that I kind of like. I get that this is like cypherpunk-y. Like, Mike, I don't know if you've, read a bunch of like the cypherpunk manifesto stuff, but they kind of write like this. They talk like this in a lot of their writings, and it's a turnoff for me. But
yeah.
All right, well, now I kind of see why maybe a lot of these people have left the Ethereum Foundation This guy, Mr. Owie, seems like a very unserious individual.
It's and if you're and again, it's that's fine. If it's a meme coin or if it's a less serious project. But I mean, we're talking about Ethereum here, and for in that case, I mean, any project that wants to be taken seriously, in finance, or any of these institutions or anything like that, or they want to attract serious investors or buyers or whatever. It's you cannot have this be your best foot forward. You can't have this be the image that you're marketing out to the world if you want to be taken seriously. I mean, if I was CEO of a major bank or an institution or something like that, and I saw Ethereum putting this shit out, I'd be it'd give me fucking pause, to be honest. I'd be like,
Yeah.
do we have to use this? If this is the people at the helm of future development, and again, I mean, I'm not, trying to, paint like just a super bearish picture of Ethereum. I mean, I think it's going to be a huge part of the financial system, but ignoring that this is like an official document on their website would be very unwise. To not at least include in your thesis on the future of Ethereum.
Yeah. So as you were speaking, I was thinking, like, what is Tom Lee saying about all this, right? Because Tom Lee's got a $250,000 ETH price target, okay, which is great. Like, I hope he's right. I really do hope that Tom Lee is right about Ethereum here going to $250,000, over however many years. But he says that Tom Lee is saying that this is a bullish development, that the Ethereum Foundation, shedding power, so to speak, is exactly what Wall Street wants. And that also he's talking here about the rise of, quote, corporate stewards. And that, Tom Lee's core thesis is that as the Ethereum Foundation pulls back, public corporations and institutional validators are stepping in to replace them as the network's primary stewards. But if you still got an Ethereum Foundation that's responsible for upgrading the network over time, and they are saying stuff like, we don't care about corporations or making money. We're here for sovereignty and freedom. That those two things seem to be diametrically opposed to me. So I would really like to see if we could find, maybe sometime over the weekend, like some type of video content of Tom Lee, expressing his opinions on this new Ethereum Foundation manifesto, which I think was dropped a couple of months ago. But yeah, we'll see.
Well, yeah, we'll definitely see. All right. So next up, we got legislative hurdles. U.S. House lawmakers are debating new crypto tax bills, of course. Analysts note that the Clarity Act currently has significant gaps in anti-money laundering oversight.
Of course it does. There we go.
Oversight for DeFi providers, mixers, and unhosted wallets, which may invite further scrutiny from national security agencies. So, as usual, the government, their focus is, one, to make sure that there's clear rules that involve them, with giving them oversight on everything and access to, our assets and, our property. The AML, the anti-money laundering, for safety to
for the children,
bad actors, bad actors,
the children.
Basically, it's a way of them knowing who holds what assets where, so that if you don't pay your 40 or 50% taxes each year, they know where to go to take your shit. I mean, that's really what it boils down to.
Yeah, it's all about theft. It's all bullshit. And you notice all of the buzzwords in that little piece there? They said national security, anti-money laundering.
It's always security.
Yeah, security. So we need some security. It's bullshit. It's bullshit. It's about theft. It's about control. And it's about making sure that citizens are not sovereign so that they fall in line and become good little tax slaves. Like, dude, fuck that shit. And those people, like the people who are, drafting legislation like that, fuck them, is what I have to say. So, the thing that bothers me about the Ethereum Foundation manifesto is that it's like, it seems super unserious, but the thing that I really like about it is the language about sovereignty and freedom. I love that. And I think that Ethereum can actually deliver on that. I hope, anyway. It would probably be better, though, if Bitcoin delivered on that with covenants. So we'll see what happens. But yeah.
All right. So next up, we got Base targets June 25th mainnet launch for Barrel upgrade and new B20 token standard. So Base's second network upgrade, get rid of that. Barrel introduces B20, a native token standard built directly on the chain's node software rather than a smart contract, and lands on mainnet June 25th. So that's in about a week. The upgrade also cuts Base's standard withdrawal delay to Ethereum from 7 to 5 days, building on withdrawal improvements introduced with the Azul upgrade in May. Coinbase incubated Ethereum Layer 2 network Base deployed its second upgrade Barrel to the Base Sepolia testnet on Thursday, with mainnet activation scheduled for June 25th. Barrel introduces B20, a native token standard for issuing stablecoins and other assets directly within Base's node software, and cuts the chain standard withdrawal delay to Ethereum, again, from 7 to 5. So it implements the full ERC20 specification and includes ERC 2612 permits, which let holders approve spenders with a signature instead of a separate transaction, making the standard a drop-in replacement for existing wallets, exchanges, and indexers built for ERC20 tokens. What's different, however, is execution. Rather than running a conventional smart contract, a B20 token is a pre-compiled contract, which means its logic is written in Rust and runs directly inside the node software instead as on-chain EVM bytecode Base set. The standard ships with an issuer toolkit covering role-based access control, mint, and burn functions with optional supply gaps, granular transfer policies, and a freeze and seize mechanism built for See, this
There
is
we go.
this is all
This is all the CBDC chain, bro.
It's all the compliance stuff,
Compliance.
And to be honest, I'm going to invest in it because it's going to get adopted. It's going to get used. I'm going to make money, and then I'm going to move that money into stuff that's going to allow me to be self-sovereign. I'm more than happy to make money off of it. It doesn't mean I'm going to keep all my liquidity there.
You're going to get taxed on it. You're going to get taxed.
We'll see. I have a brother that knows how to structure stuff to where I can mitigate my tax burden.
Yeah, well, I mean, this is the framework for a CBDC chain.
Oh, absolutely. No, absolutely. Come on, speaker. All right. So 2 variants are available at launch, including a general purpose asset version and a stablecoin version with fixed 6-decimal precision and an issuer defined currency code. Let's see if we can faster withdrawals.
You know what they're going to do next, Mike? They're going to have KYC. So you're going to pretty soon here. You're going to have to KYC to use the Base chain.
Oh, dude, I'm sure. I mean, it's probably it's just basically what's going to be is like all the platforms that are on Base. It's going to be to where like Aerodrome, you're going to have to KYC on freaking Morpho. Any of the protocols that are on it. They'll just have you KYC because if you KYC the entry and exit points, then basically the chain is KYC.
Yeah, that's basically like choke point 3.0.
Yeah.
Choke point 1.0 and 2.0, they were all about not being able to get on and off. But now it's just like, okay, you can get on, but we're just going to track everything you do.
Yeah, it's going to be like a toll road. You have to go through their gates,
Yeah, well, I think that when they start rolling this stuff out, the demand for a sovereign chain like Bitcoin to have
It's going to
like
increase.
real contracts, yeah,
Yeah.
yeah.
Well, and like I said, I mean, I have no problem with with making my money on base and stuff like that, but I'll be moving the majority, if not all, that I'm not actively using in DeFi on base. It's going to go into something like Bitcoin or on mainnet somewhere to where they can't freeze it, they can't seize it, they can't freaking steal it from me. Oh, it looks like he lost his audio. So I'll keep reading a little bit about this. When he gets back, it's getting to be about the point. So actually, you know what? Today, we're actually going to be looking at either Jupiter, Solana, or Hedera. So I did 3 deep dives today for the show. And then I'm just going to kind of let David choose. I think we're going to be probably going to do Solana and Jupiter. Jupiter is a DEX that's on Solana, and we've neglected to do Solana so far. And in Jupiter for a minute there was, I mean, a huge player, especially at the peak of the meme coin. In Solana's use and things like that. Jupiter, kind of before the before not Avantis, before Aster and before Hyperliquid, Jupiter had a minute to where it was, the talk of the town. A lot
Oh
of
yeah.
So I kind of think maybe we'll save Hedera for Monday, but I kind of would like to see Solana first, since Jupiter's on Solana. So start out with Solana and then do Jupiter.
Sweet, let's do it.
All right, you want to take the helm?
Yeah, let's dive in. So Jupiter, Solana, Hedera. We're gonna start off with Solana, and let's check this out here.
When massive streams of institutional financial data surge across the globe, they require execution layers capable of sub-second settlement. By February 2026, the Solana network processed approximately $650 billion in stablecoin volume in a single month, operating as a primary enterprise rail. In Q1 2026, top-level applications generated $451 million in gross domestic product. In contrast, the base L1 protocol captured only $89.9 million, a 68% drop in protocol revenue compared to the previous year. There is a common assumption that high stablecoin velocity and massive transaction counts automatically generate protocol-level revenue. They do not. To understand this value gap, we have to look at the specific 2026 architectural upgrades that optimize the network for extreme velocity and the distinct monetary policies that let the resulting value leak out. Under its original design, the Agave validator client struggled with the physical compute constraints required to process sudden, intense market volatility. This diagram compares the architectures. To solve ingestion, FireDancer abandons the monolithic structure, splitting tasks into discrete CPU processing tiles. By isolating stages like signature verification, if one experiences a backlog, it doesn't stall the pipeline. The network continues absorbing data. Fixing the client software solved transaction ingestion, but the legacy consensus framework, Tower BFT, created an internal limit on throughput. This pie chart represents a single legacy block. The red section, roughly 75% of available space, was consumed entirely by validators submitting on-chain vote transactions. Alpenglow implements Voter. This voting overhead is pulled completely off-chain and compiled into compact cryptographic consensus certificates. Through local cryptographic signature aggregation, validators agree on the block state rapidly, achieving deterministic finality in under 150 milliseconds. To guarantee that speed, Voter uses a concurrent commitment model. It relies on a fast path when over 80% of validators reach consensus, and falls back to a slow path that still settles in under 150 milliseconds when participation drops. Alpenglow also applies a 20+20 resilience framework. This keeps the blockchain functional even if 40% of the active stake is offline or malicious, choosing guaranteed liveness over absolute safety thresholds. Together, these upgrades established a high-throughput, low-latency execution layer. But in optimizing purely for speed and throughput, The architecture created a structural tokenomic imbalance. If the physical infrastructure efficiently handles billions in daily volume, the lack of value capture traces back to how the network prices that execution. The base fee of 5,000 LAM ports splits perfectly in half, 50% to the validator and 50% into an incinerator. Priority fees originally followed this split, but users began bypassing the market, paying side bribes directly to block producers to guarantee transaction inclusion. To eliminate these out-of-protocol deals, the validator community activated the SIMD0096 proposal. This dynamic update severs the burn mechanism entirely, routing 100% of priority fees straight to the block-producing validator. This aligned validator incentives, but it removed the protocol's main engine for generating deflationary pressure. High network demand directly enriches validators, but it does not reduce the circulating token supply. The lack of deflationary pressure is further exacerbated by the physical speed of the network, creating a velocity bottleneck. With block times of 400 milliseconds and sub-cent transaction costs, institutions can cycle billions of dollars of commerce without maintaining large liquid reserves of the native token to cover execution. When Western Union launched its regulated USDPT cross-border pilot, the high network efficiency allowed them to settle transactions with local payout agents in minutes, eliminating the need to hold idle token balances across their system. High gas fees and unpredictable congestion on other networks force users to hold thick liquid reserves of the native asset. Solana's sub-second execution explicitly removes that requirement. This extreme transaction efficiency actively suppresses structural holding demand. The token cycles rapidly between hands as a transient utility fee, limiting its ability to accumulate a monetary premium. For retail holders and native stakers, there is an assumption that staking guarantees a profitable share of the network's high volume. This waterfall chart breaks down actual on-chain returns. In mid-2026, the nominal staking reward rate ranges between 5.2 and 7%. However, those rewards are largely paid through new token issuance. In the first quarter of 2026, the protocol minted 6.26 million new tokens. Set against that issuance, the base fee engine burned only 677,000 tokens over the exact same period. The difference results in an annualized net dilution rate of 4.38%. Accounting for that structural dilution, the real economic yield, from actual transaction fees, averaged just 0.17%. Every time newly minted tokens expand the circulating supply, they dilute the value and proportional purchasing power of all outstanding assets on the network. Without altering the underlying issuance parameters, the continuous flow of structural emissions will erode passive investment value, regardless of how much external economic activity the network settles. To close the disconnect between the execution layer's utility and the protocol's value capture, the network is advancing two critical governance proposals. First is SIMD 547, replacing flat base fees with dynamic pricing tied to four resources: compute units, data loaded, bytes transmitted, and write locks. Crucially, 100% of these fees channel straight into an incinerator, permanently removed from circulation. Running this complex fee logic under the legacy consensus framework would have doubled validator voting costs. The dynamic pricing is strictly dependent on the block space freed up by Alpenglow's off-chain voting architecture. By forcing complex operations to pay proportionally for resource consumption, current modeling projects that daily token burns could scale from roughly 600 tokens to tens of thousands. The second fix is SIMD 0550. This graph maps the original inflation decay curve, with its trajectory extending to a 1.5% terminal floor in 2032. This proposal doubles the annual disinflation rate, compressing the timeline to reach that floor by 2029. Compressing the schedule permanently eliminates nearly 19 million tokens from the future emission supply. But the policy carries a sharp operational penalty. Cutting emissions this aggressively will more than double the stake required to run a profitable validator, threatening smaller independent nodes with insolvency. The engineering layer is fully built to process global enterprise volume, but translating that velocity into true token scarcity requires executing these structural economic policies.
Well, so I knew that it was the case, Mike, that the Solana coin, that if you stake Solana, you break even. I knew that was the case. Now, I guess I've got there's a gardener guy. He's outside. I don't know if you can hear that or not, but I certainly can. So yeah, Solana. It sounds like even the proposal there to fix the tokenomics, so to speak, would make the network even more centralized. So how many validators are there for Solana right now? I don't know, but I was under the impression that it was, quite centralized, especially when compared to Ethereum, or in the extreme when compared to Bitcoin. Now, Bitcoin doesn't have a smart contract layer, of course, but just taking a look at this, that doesn't exactly inspire confidence, So yeah, let's just hop on over here to DeFi Llama real quick, and let's take a look. So as DeFi TVL continues to collapse, from $165 billion in the beginning of October, all the way down to 72 billion now, let's take a look at the Solana chain. Okay, good. Thanks for letting me know, Jay-Z. And also, can you guys hear like any background noise? Like, do you hear me breathing anymore or anything like that? Because if not, no, you haven't.
Yeah.
Okay, good. Yeah, so I changed the setting on my mic. I was hoping that would fix that. Okay, so if we're taking a look at Solana DeFi TVL, it's comparable right now with the base chain DeFi TVL. We take a look at the top protocols on Solana. The first one is Jupiter, which is what we're about to take a look at. And then, we start taking a look at a money market like Camino. Sanctum is a big liquid staking protocol. Radium is a decentralized liquidity provision exchange and also perp-stacks. Binance Stake Sol, again, liquid staking protocol. Jitto, liquid staking protocol. Securitize, these guys have, basically like treasuries and stuff on Solana. Solstice, I guess that this is, basis trading. X stocks, we know what that is, RWAs, so tokenized equities. So you got, these are the top 10 protocols here. It's basically, liquid staking protocols, a perp stacks, and a big money market. That's what you got going on over here on Solana. And then once you get down past the top 10, the DeFi TVL, a lot of these protocols starts to decline quickly. I can't believe that Drift still exists. After that exploit and the way that they responded to it, I'm surprised that they've got any DeFi TVL left at all. Okay, so let's take a look. Are there any protocols on Solana that over the last month have experienced significant increases in TVL? And I want to take a look at protocols with a minimum of like $1 million in TVL. That would be like a really small protocol. And so let's just see if I sort by 1 month change. We've got something called Stake Point. This is a farm. I haven't seen this one before. We've got a DEX called Flux Beam. And what I'm looking for is protocols that say one chain. So I'm looking for native protocols to Solana. Mm-hmm. We got something called...
Isn't Jupiter one?
Yes. But what I'm looking for, though, is... yes, Jupiter is native to Solana. But what I'm looking for is like a new protocol, or maybe a protocol. It doesn't need to be new, but something where it's experienced a lot of inflows in DeFi TVL. Because if I see massive inflows in TVL, that could mean that they're doing something interesting. So let's take a look at Stake Point, because it looks like this thing went from 0 to 7 figures pretty quick here, basically overnight. It says multi-pool staking protocol on Solana supporting SPL tokens and token 2022 tokens with fixed APY and variable APY pools. Fixed APY, huh? Okay, I'm interested. Let's check this out. Alrighty, we got trending pools. Let's take a look at those fixed pools. What's that all about? Okay, so I've never looked at this protocol before. Not familiar with this one, but I'm curious enough to at least take a look here. So, a staking pool or lock tokens and provide liquidity on Solana. Okay, so it says supports Radium, Meteora, Orca, and Pump Fund. So those are the big, liquidity provision, decentralized exchanges on Solana. So why don't I just take a look here? LP locks, token locks, lock tokens or LP. Let's click View All Locks. So what is this? Lock SPL tokens and LP tokens on Solana with verifiable on-chain security. Locks are held in program-derived addresses with no private keys and unlock only after the unlock date. So I'm assuming that there's some benefit to this. What is the benefit to this? So, okay, these are memes. Largest amount. Let's sort by active. And instead of sorting by largest amount, how about, maybe longest duration? And what exactly is the purpose of locking these meme coin LPs here? So here's cat with hat. Where's a big one? Like, is there a whiff, like a dog with hat one? Cat with hat. There's no dog with hat. The dog with hat one was the big one, but what's the point of locking? So why lock tokens? It says token locking is how Solana projects prove they cannot withdraw liquidity. Oh, okay. I see. I got it. So, and yeah, Jeff, you're right. I know that Solana only has a handful of validators, but I don't know how many. So like Tron, I think it's 27. Sui, I think it's like very, very few, because you need a ton of Sui to be able to become a validator. Mm-hmm. Solana, I think, is more decentralized than Sui, but Solana's got big tokenomics problems, as we just learned. So if they try to fix those tokenomics problems, then they're going to make their validator set even smaller, it looks like. And I see what this locking is now. So when you launch a meme coin on Solana or on any protocol, any chain, and then once you launch the coin and you initiate the liquidity pool for it, a big way that a lot of these meme coin scammers were rugging people is they would launch a coin, and then it would they would initiate a liquidity pool, and then they would hold the NFT, so 721 validators. Yep. So that's really small. How many validators are there? How many Ethereum validators are there? I think it's in the thousands, I believe. Not sure there, but so yeah, when you create
for those that don't understand, the role that validators play is the more the validators, the less centralized it is. So in the less validators, that means that there's fewer validators that decide consensus.
Right.
So I mean, I just want to make sure that people understand kind of the significance of the number of validators.
Yep. That's exactly right. And if I'm looking over here at this Stake Point app thing, so this one basically went from 0 to 1.5 million in TVL overnight. And so I understand what this is now. So when you launch a meme coin and then you initiate a liquidity pool, after you initiate the pool, you hold all the LP tokens. And so, yeah, look at that. Ethereum has close to 900,000 validators. Wow. So you talk about decentralization, that's quite a bit different than 721 for Solana. And I think Sui has like 70 validators, I think, something like that. So yeah, Jeff is showing us that, hey, decentralization in validator sets matters. But this protocol here, so basically, if you lock your LP tokens or your NFT after you initiate a liquidity pool, then that verifies for anyone who wants to trade your meme coin that you can't rug them by withdrawing all the liquidity from a DEX. So this is useful if you want to verify that the meme coin that you're gambling on can't be just rugged out from under you. So, all right, and that's enough of that. So stake point, yeah, I'm going to pass on stake point. And then I want to sort by this again, Hubra. What is Hubra? And again, I'm just looking for some type of DeFi protocol on Solana where the TVL is going up, because that could mean that there's some type of opportunity there. So Hubra.
This one looks interesting. I mean, just basically it flatlined as far as TVL, and all of a sudden it spiked, and looks like it's consolidating at a decent level.
Yeah, and is that okay? So inflows, that's inflows. Got it. So on the right axis, that's inflows, and this on the left axis is TVL. So let's see here. Hubra is a Solana-based DeFi protocol providing institutional-grade, non-custodial yield products, including liquid staking and automated yield vaults on stables. It's designed to make professional yield strategies accessible to everyone. Okay, so it sounds like basically a crypto hedge fund on Solana. That's what it sounds like. So let's take a look at some of these. Oh, look at that. SUI, 120 validators. So 127 validators. So very not decentralized. It is not decentralized. So
it is decentralized. Not.
It works. Not. Yeah. It is working. Not. Yeah. That's SUI for you, man. So here's Hubra. What is this? A Solana staking service for long horizon SOL capital. Self-custodial by design. Product. Liquid stake. USDC earn. Let's see. Okay, great. So let's take on a bunch of smart contract and counterparty risk for a big fat 5.5%. That sounds like shit. No, thank you. Yeah, no, thank you. I'm going to pass on Hubra. Let's go back on over here to this here and take a look at Fluxbeam. So this is a Solana DEX. It says supporting innovation and token 2022. And I wonder what happened here with this TVL. That's kind of funky. So we're just looking for, a protocol on Solana that's actually performing well and like seeing inflows. And I mean, Fluxbeam Infinity, next generation trading on Solana. So look at the UI. The first thing that I noticed, this user interface. Like, if you thought that the Ethereum Foundation manifesto was unserious, this is like the definition of unserious. This is basically gambling. Like you got a cooking Trump. Like let's see what's going on with cooking Trump. Yeah, looks like it's not cooking. This is what not cooking looks like. Yeah. Yeah. So, all right. What else we got going on this thing? Smart money. What's the smart money? Connect your Telegram. Okay. Trending. This is just meme coin stuff. All right. That sucks. Let's go back on over to DeFi Llama and see if we can find something else. So Nest Credit is seeing some big inflows on Solana. Maybe take a look at Nest Credit. Nest Credit provides native yield from tokenized RWAs on Plume. So this is the Solana version of Nest Credit.
Yeah.
So
Nest is native on Plume, but is also on Solana.
Yeah. So look at this shit. Americans can't even benefit from this because the IRS hasn't decided how they want to steal all your money yet. So you can't use this.
I got to do VPN.
Yeah. So let's go back on over here and let's take a look at Solstice, that's basis trading. I looked at this one. This one was boring. So here's Solstice, the yield layer. It's got oh look, they got a 3-year track record without blowing up. Cool. Let's check launch app. And here's the app. So it looks like 1-click yield of less than what you could earn risk-free by holding US Treasuries. That sucks. And Deep DeFi, Solstice Partner, highest APY 18%. Okay. What is USX and EUSX though? Learn more. So fixed staked SLX yield. So looks like this is, oh, you see that? PT. So this must be, so this is fixed. These are bonds. These are zero coupon crypto bonds. So you're earning a fixed staked Solstice, so staked LSX. But it's like, okay, you're earning 18% on SLX. What exactly is SLX doing, like in terms of performance here? Let's check this out. So over here on DeFi, this is a trading view, excuse me. Solstice. Yucky, man. So this is just the Bing X. Bing X is a centralized exchange that used to be non-KYC. I used to trade on there when it was non-KYC. And then the moment that they KYC'd, I was just lucky to be able to get my money off of there. But yeah, it doesn't matter if you're earning 20% APY if the token is just down and to the right. Like if the token just goes down, then you can earn whatever yield you want, unless you're doing 20,000%. It doesn't really matter. So that sucks. Let's go back here and see if we can find something else. We took a look at StakePoint, Hubra, Fluxbeam, can't even look at Nest Credit, Solstice, X stocks. This is tokenized stocks. I can't even use this one either, though. These aren't legal for U.S. citizens yet, but you're seeing big inflows. So if we go back here and I sort again, what is Futarchy? Raise money while putting ownership into the hands of your early users and believers. Okay, I could maybe get behind that. Let's see what's going on. It says launch an ownership coin. Raise money while putting ownership into the hands of your early users and believers. Raise USDC, spend it responsibly, win together. Okay, this is, this sounds kind of interesting here. From hackathon stage to public markets. Coliseum runs the hackathons. MetaDAO runs the markets. Together, the two platforms give a founder a clear shot. Ship in the arena, graduate into the accelerator, raise through the stamp, and launch a tokenized Futarchy governed DAO. So anarchy, Futarchy, future anarchy, is that what they did there?
I guess so.
Like, dude. Come on, guy.
Yeah, come on, pal. Come on, friend.
Oh, man. Launch a project the right way. Skip the low float, high FTV playbook and get funded by your community. I mean, that's a great idea. Fair launch early, transparent, raise more, real alignment. Okay. We don't vote, we trade. How do I use this? Projects, about, sponsors, more, sign in. Okay, so I've got to connect a wallet to be able to use this at all. Let's take a look at projects. Featured project, peer-to-peer protocol, P2P protocol, decentralized stablecoin on-off ramp for emerging markets. I like this. View project at p2p.me. Here, Mike, check this out. This actually looks kind of interesting. It looks like the launch has ended. So this is a live revenue-generating, non-custodial fiat to stablecoin on-off ramp. It says we're a leading decentralized on-off ramp, processing the highest monthly volume in this segment. The protocol matches users to merchants on chain based on staked USDC. Most trades settle in under 90 seconds and generates revenue entirely from transaction fees. We are currently live on Base and launching soon on Solana. I like this. This is interesting, man. So let's yeah. So it says here's the problem: billions of people in emerging markets need to move between local fiat and stablecoins. Centralized ramps custody user funds and can freeze accounts, censor users, expose user data to governments, or shut down entirely. Yeah, very true. Existing peer-to-peer platforms lack on-chain accountability, violate user privacy, disputes are settled off-chain, and these platforms are infested with frauds and scams. That's so true, man. Have you ever taken a look, Mike, at these peer-to-peer platforms? Where you basically would, and I don't know if it's I've never actually used one because every time I've looked at them, it just screamed scam to me every time. So like, and the whole idea also of peer-to-peer in person, like imagine going to buy Bitcoin peer-to-peer in person, where like you set up a meet over, some protocol, and then you got to go meet some dude like at a McDonald's or whatever, or a public place, where
no bueno,
like,
no bueno.
Like, and that person knows you're showing up with, $10, $20, $30,000 to buy Bitcoin. Or if you're going to buy a whole coin, you're showing up with $63,000 in cash. And that person is going to send you 1 BTC. And then you're going to sit there for an hour as it confirms 10 times.
Yeah. So
like that is danger, Will Robinson, danger.
Hard to pass.
Yeah, no, thank you. So it says on platforms like Binance peer-to-peer, nearly 1 in 3 participants report experiencing scams, according to community surveys in emerging markets. Yeah, no kidding. So it says here's the solution. Peer-to-peer protocol coordinates fiat to stablecoin trades without custodying fiat. A user clicks buy USDC or sell USDC, and the protocol assigns a merchant on-chain based on their staked USDC. Merchants provide fiat liquidity on local payment rails. So they got a couple of examples here: UPI, PIX, and QRIS. I don't know what any of those 3 are. And then it says, while settlement, matching, dispute windows, and fee routing all execute on-chain with no back-end server or PII retention. I don't know what UPI, PIX, or QRIS is. I don't know what PII retention is. We've got to take a look at that at some point. It says fraud prevention is handled by the proof of credibility system, which combines zero-knowledge TLS social...
What was it called? PII what?
PII retention. Yeah. So let's see here. New users verify social accounts and government IDs through zero-knowledge KYC. So zero-knowledge proofs via Reclaim protocol. They earn reputation points with each successful trade and unlock higher tiers as their on-chain credibility grows. So that's cool.
Basically, it's like KYC and AML stuff. In the context of cryptocurrency and blockchain, PII, personally identifiable information retention, refers to the policy systems and legal obligations that dictate how long a service provider, like a crypto exchange or custodian, stores the personal data of its users.
Got it. Okay. So let's see here. It says it's live in Brazil, India, Argentina, and Indonesia. Okay. So let's see here. How could we...
Or anybody with a VPN?
Right? Like, I want to see if I could, like, how does this work? See, these are the jurisdictions where people actually use crypto day to day. Latin America, Asia, Southeast Asia. I don't know what MENA is, and Africa. So these are the places where they don't have, regulatory bodies to tell you no. So that's where you get all the innovation. So,
Well, I mean,
Let's see here.
it sounds like a lot of the places where a lot of remote workers come, or not remote workers, but a lot of workers that because India and Malaysia, places like that. A lot of those people go to like the Middle East, and they work as housekeepers, they work as gardeners, things like that. They work in the food industry. They're the workforce, and they want to send money home. So a lot of these people, they've embraced crypto because a lot of them can't get bank accounts. And so they've learned, using Starlink and stuff like that, they've learned to use these apps and these applications, to onboard, the money that they make. And instead of using Western Union that used to bend them over and take like 20% or something like that, they started using crypto to where with a couple of clicks and a couple of seconds they can send USDC, USDT, or whatever crypto they want value back to their family that can use it to buy food, to buy whatever.
Yeah, and take a look at this, Mike. Coinbase Ventures invested 500K in this protocol in February 2025.
Yeah.
So that's a vote of confidence. Okay, so here are the links. I like this Meta DAO. This is cool as fuck.
So go to their X account. I wouldn't mind adding them.
Yeah, definitely. So peer-to-peer foundation right there. So here's peer-to-peer foundation. I'm going to follow.
So
and
foundation. All right.
P2P foundation, private peer-to-peer on off ramping has been solved. Dude, so if we got private peer-to-peer on and off ramping, plus with near private, layer one swaps, native spot layer one swaps.
Can you I want to make sure I'm following the right one. Can you go back to the X account?
Yeah. X account is this one at peer-to-peer or at p2p.found.
Okay. At p2p.found. All right.
So this is super, super cool, man. And I like this MetaDAO DApp or website or whatever it is too, because this MetaDAO thing here, Mike, like it's basically like all sorts of really cool projects that are raising money right out in the open. I like that. So you can see some of the coolest projects, I bet, on here. See, Solana's not worthless. I've still got my Solana Seeker. I put that thing in the closet. It didn't exactly do a whole lot, but
I'm not able to find their X account. What is the website you're on?
Here, let me just put it in the chat. That way, that'll be a little bit easier, I think. So if I go to share and I want to copy, we're going to go ahead and pop this in. Oh, whoops, that's a lot. Let me just go like this, peer-to-peer.found, like that. So that's the X account right there. And then here's the website right here. So let's take a look. I want to continue to look at I want to look at the protocol website. Okay, so that's the website. Got it. Where's the dashboard? Protocol dashboard. Here it is. p2p.me. Okay, so how does this work? I'm going to say that I am Argentinian. I'm Argentinian right now. Okay, so how buy-sell price, campaigns, governance, regional breakdown.
There we go.
Okay, monthly orders, USDC volume.
Man, this is a really project. They only have like 2,000 followers.
Yeah, and it looks like, so let's see here. I'm on their, I think this is their website, or this is like how you would use it. If I go to orders, how do I use this? Like, how do I actually use this? How does this work? So circles, stake and earn yearly rewards from trusted communities. Okay, got it. Circle registration, connect your admin wallet. Alrighty, users, So this is a private on-off ramp solution. It's peer-to-peer. And the URL that I'm on is, you're going to love this, Mike, p2p.lol. There we go. Yeah. This is actually a more serious project than a lot of the other ones with, so let's see here. Buy, sell price, buy price, sell price, current buy price in, okay. So ARS, that must be the currency in Argentina, right?
That sounds about right.
Yeah, so let me see if I can find it. ARS USD, yeah. This has to be. I'm going to look over here at Forex, Argentine peso. Got it. So I want to go USD ARS actually. Dollar peso. Yeah. So it's roughly 1,500 Argentinian pesos to the US, to the dollar. And wow, that's a yucky looking chart right there. So this is, if we invert this scale, this is what the purchasing power of the Argentinian peso looks like since 2021 or so. So this is no bueno. Let's bring it on back to peer-to-peer. Okay, so how would I use this? Real-time pricing. So this is the pricing, but how do I sell my pesos to buy dollars? How does this work? If I connect wallet, okay, I can connect any of these wallets. Awesome. But I don't know that I really want to. All right, let's see. What else can we do here? Campaigns. What is a campaign? So complete list of all campaigns with their activity and performance metrics. Alrighty, claims, managers, governance, my profile. Connect your wallet to view your stakes, track rewards, manage your staking portfolio across circles. So Mike, I think that this is definitely something worth doing some deep dive research on. P2P.me, the peer-to-peer protocol. And also, maybe at some future date, this MetaDAO, because the projects here on MetaDAO, or at least this one, peer-to-peer protocol, this is super interesting stuff. And if there's a token associated with this and legit tokenomics, you talk about, finding a diamond in the rough, that's what this stuff kind of is, so potentially anyway. Yeah. So let's see, permissionless launches. GSIM, the privacy layer for on-chain lives and journalists. Okay, let's check this out. GESIM, privacy layer for on-chain lives.
How about we do this? How about I put this on our list of deep dives and we move on to Juke, because we only got about 20 minutes left.
Oh, good. Yeah, let's move on to Jupiter. Dude, these so far, Mike, I gotta say, these projects that just the last two, this is kind of interesting. Here's the last one before we move to Jupe. Jurassic Finance, tokenized dinosaurs. What exactly is this?
What was
tokenizing? This is so cool.
We got a P2P protocol, and what was the other one?
MetaDAO. And also, just throw this on there. Jurassic Finance, bro. Check this out. Tokenizing museum-grade dinosaur fossils on Solana. Rawr, Jeff. Rawr.
You said it's Jurassic Finance?
Yeah, Jurassic Finance. You see, what we were talking about on the Red Pill yesterday, Mike, with your brother, about being able to tokenize real estate.
Yeah.
We might be able to learn a little bit about how to tokenize stuff by learning more about this Jurassic Finance. I mean, look, dude, if you can tokenize fossils, you got to be able to tokenize real estate or cars, right? So, yeah, this looks cool. All right, enough of this. Let's hop on over and learn a little bit more about Jupiter. So Jupiter is the largest DEX, the largest perps DEX on Solana, but it's more than that. It's also a money market now, and I think it's also an on-off ramp. Like they've built out so much stuff into Jupiter. So let's check this one out. This will be good.
By mid 2026, Jupiter Finance officially processes over 80% of the entire Solana network's retail trading volume. The platform evolved from a decentralized exchange.
80%. 80% of the volume flows through Jupiter on Solana. Wow.
Aggregator into a verticalized DeFi super app. Through aggressive engineering and strategic acquisitions, it absorbed the ecosystem's charting, portfolio tracking, and execution routing. This dominance translates into significant financial throughput, generating upwards of $100 million in annual protocol fees. However, that revenue does not flow to a decentralized collective. Jupiter Exchange is operated by a private corporate entity domiciled in the British Virgin Islands. That entity captures 100% of the platform's cash flow. Meanwhile, the native JUP token trades on the open market as a governance proxy. It holds no legal claim to the platform's revenue.
Uh-oh. This is no bueno. How many times have we seen stuff like this where, the protocol, all the revenue that the protocol generates, it flows to some business entity somewhere, and exactly zero of it flows to the token holders in the form of some type of value accrual. Yeah. That's what this just said.
Well, and that's a major part of what people think. And I mean, that's what I've been doing. Sorry, I've been kind of distracted. I've been on X, kind of chatting with people and setting up that gentleman to come on the show about Kita. But I mean, that is the huge thing that people, I really haven't heard anybody else, as far as educators or influencers, really dive in and detail what exactly value accrual is. We're one of the few out there that are doing it on a regular basis, like almost every episode, because it's such an important aspect of why buy these tokens. If there isn't value accrual to where you benefit, it doesn't matter how bullish you are on the project. It doesn't matter how many agreements they have or how many partnerships they get or what they launch, or it doesn't matter how much money it makes if there isn't a connection to the token through the tokenomics. And we're not just talking about the max supply and the circulating supply. There's a lot more to tokenomics than that. There needs to be a direct connection for a price to go up depending on how profitable the company is. Otherwise, there's no point to buying the token. And all of you out there that are on X, that by all means, call us whatever you want. You are doing yourself a disservice by simply calling something FUD because you feel like it's talking bad about your project. You need to keep an open mind. You need to educate yourself on why you should hold this token. Again, it doesn't matter how much bullish news comes out about your project if there is no connection, that your token has no connection to that success. It's like it's akin to you buying a football jersey of your favorite team that won the Super Bowl. You don't benefit in any way whatsoever than it makes you feel good that your team won.
Actually, Mike, I would say that buying the jersey has more of a connection to some type of value accrual than the token does.
Well, like that's if it's it could be
people are going to want it
at some point.
Yeah. Right, yeah. But like the token, like who gives a fuck about that? Like the whole point is if the business makes money, those revenues got to flow back to you, the token holder. And let me replay that part here just so that we can hear that again.
That's what I've been doing for like the past deep dive is just going back and forth with these people, and most of them is just temper tantrums. They're just trying to call us bitches.
Well, so check it out, Mike. This is what I'll do today. I'll take another note to do this. What I'll do, I'll just throw it on my thing. My agenda is I really want to build out that in the website.
Yeah, where people can fill out.
Friday, June 19th.
Well, and I'll be honest, Crux, I mean, I've watched some of his content. He does really good content, and he's made a bunch of money in crypto, and like over a couple of cycles and stuff like that. And he's a military vet, so I respect that. And he's been very respectful. Back in our back and forth conversation, he's just like, hey, I really feel like you guys are missing some points on Kita, and I'd love to come on.
That sounds good.
Absolutely. I would love to have you on, Crux. So yeah, we're just dialing in a time for him to come on because I mean we do. I mean all we're doing is pointing out our findings. Some of it's going to be good, some of it's going to be bad. Yeah, but it's the whole picture. We're not just going to hype up projects on this channel.
And it's truth seeking.
Yeah.
Like, there's nothing wrong with making a mistake when you are genuinely in search of finding truth. Okay, so if we miss something, like, I want to know.
Yeah.
Like, I don't want to stick in some echo chamber where I just continue to reinforce my own, cognitive biases. All I want is truth.
Yeah.
And yeah, man, if he's got information that we missed, dude, I would love the opportunity to talk to him. So let's bring it back to Jupiter. Here's a little bit more about Jupiter. We've got, looks like 8 minutes in this piece of video content.
Through aggressive engineering and strategic acquisitions, it absorbed the ecosystem's charting, portfolio tracking, and execution routing. This dominance translates into significant financial throughput, generating upwards of $100 million in annual protocol fees. However, that revenue does not flow to a decentralized collective. Jupiter Exchange is operated by a private corporate entity domiciled in the British Virgin Islands. That entity captures 100% of the platform's cash flow.
There we go.
Meanwhile, the native JUP token trades on the open market as a governance proxy. It holds no legal claim to the platform's revenue and earns no direct trading fees. This creates a structural paradox. A highly profitable private company runs the routing brain of Solana, while the public token lacks an active on-chain mechanism to share in that profitability. To bridge this divide without triggering regulatory action,
really
Jupiter
quick,
is beta testing specific tokens.
If anybody out there, I know there's a lot of people bullish on Jupe and there's a lot of people bullish on Solana. Anybody out there, and this isn't a challenge like, come at me, bro. But if you feel like that this is wrong, if you feel like there is value accrual, that there is a connection to the profits of the protocol and the Jupe token, please send me a message on X. It's at the node_network. Send me a message. If you have actual value to bring to a show, we'll have you on and you can state your case.
Absolutely, man, 100%. It seems like there might be something in this piece of video content about like how they're trying to bridge that divide between like how much money the protocol generates in fees and like actually returning that to token holders in some way, maybe.
That's the other thing that can change. Tokenomics change all the time. Arrow is about to change theirs. Ondo, if they have that vote that everybody keeps talking about, and for some reason they vote to make it a utility token, that would change our whole narrative on it. As these things evolve, we're going to change our view on it, but we're always going to report the whole picture that we're able to find.
We're going to report what we know to be true at the time.
Yeah.
So let's check it out. Jupiter.
Tokenomic interventions, specifically a pivot to net zero emissions and a proposed 70% direct burn mechanism. Solving this misalignment addresses a specific technical hurdle: whether the economic success of a private company can be mathematically linked to the market value of its public governance token. To understand the cash flow, we have to look at how Jupiter's product matrix captures capital. The protocol is engineered as a self-reinforcing liquidity flywheel, designed to keep user activity within its own verticalized ecosystem. The foundational layer is the Metis routing engine. It acts as the intake valve, pulling external capital into the Solana ecosystem through cross-chain aggregators and optimizing trade execution. This flowchart traces how external capital enters the router and feeds the perpetual futures exchange. Traders execute leveraged positions against a dynamic basket of assets called the JLP pool, which contains Sol, Ethereum, Bitcoin, and stablecoins. To maintain deep liquidity, the protocol takes 75% of all trading fees generated by the Perpetuals engine and distributes them back to the JLP depositors. The structural glue holding this routing and yield matrix together is their native stablecoin, JEP-USD. Its reserve architecture is highly specific. 90% of JEP-USD is backed by USDTB, a licensed stablecoin collateralized by BlackRock's Buildle Fund. This integration takes the security of tokenized US Treasuries and injects a 4.0 to 4.5% baseline yield directly into the Solana DeFi network. Users deposit this Jup USD into the Jupiter Lend protocol to receive a liquid receipt token, JL Jup USD. That token remains composable, meaning the user can deploy it into trading strategies while
That's
still
pretty
earning the
cool.
underlying treasury-backed
That
yield.
is super cool.
Previously, the platform relied on third-party stablecoins like USDC for margin and settlement. Minting Jup USD allows the protocol to retain the underlying asset yields and seigniorage within its own ecosystem. This vertical integration maximizes total value locked. The longer capital remains within the ecosystem, the more continuous transactional fees are generated and routed to the BVI entity. We need to examine the legal realities of who controls those fees once they are collected. The private BVI entity employs the 73-person development team in Singapore. They maintain the authority to modify smart contracts, manage the front-end infrastructure, and capture all trading revenue. The decentralized autonomous organization, the Jupiter DAO, has no access to those funds. It operates as an administrative cost center with an $11 million annual budget, funded by historical token emissions. This structure creates a misalignment, where a private company holds the proprietary code and the cash, while relying on a public token for governance functions. A simple resolution to this divide is blocked by the constraints of the Howey test. If the BVI entity were to implement direct revenue sharing, distributing a percentage of that $100 million to JUP holders as a cash dividend, it would trigger immediate classification as an unregistered security. A legal wall prevents the DAO from touching the cash. Consequently, the engineering team is constructing indirect methods of translating corporate success into token value. By early 2026, this indirect structure faced a challenge. Massive scheduled token unlocks threaten to increase the circulating supply and affect the asset's market price. We can visualize the threat using this equation. Market cap is equal to the circulating supply multiplied by the price. Under the original model, 3 distinct inflationary variables were scheduled to increase the circulating supply, which mathematically places downward pressure on the price to maintain the balance. The first mechanism of the Going Green initiative addressed the annual Jupuary airdrop. 700 million tokens were postponed and returned to a cold storage multisig, requiring a future DAO vote to access. The second mechanism targeted internal emissions. Scheduled open market team vesting was suspended. Instead, those allocations were converted into internal credits held against the corporate balance sheet. The final mechanism absorbed sell pressure from historical Mercurial stakeholders. If those wallets sold tokens on the open market, the corporate treasury executed equivalent on-chain purchases to absorb the supply. These 3 interventions drove the net inflation of the Jup token effectively to 0 for the remainder of 2026. Halting the dilution protected the denominator in the valuation equation, improving the ratio of market cap to fully diluted valuation. But this was a defensive measure. The net zero pivot stopped the bleeding, but it did not funnel the BVI entity's cash flow to the token holders. To capture actual value, the protocol required an offensive strategy. In 2025, Jupiter utilized the Litterbox Trust, a mechanism that dedicated 50% of protocol fees to buying back JUP tokens on the open market.
Okay.
Jupiter CTO identified a flaw in this approach. Repurchasing tokens and transferring them into a locked treasury does not permanently reduce the circulating supply. Locked tokens remain factored into the fully diluted valuation by market aggregators, and they fail to mathematically offset future structural unlocks. This chart shows the May 2026 governance proposal designed to fix the inefficiency. It increases the buyback allocation from 50% to 70% of total fees. More importantly, it executes a mechanical shift. Instead of storing the purchase tokens in a locked vault, the protocol instantly and permanently burns them. To achieve this volume, the private BVI entity explicitly reduces its own treasury and development allocation down to just 30% of total protocol revenues. This mimics the model used by Hyperliquid, executing direct, protocol-enforced revenue burns to generate sustained upward buying pressure. This mechanism navigates the legal constraints by creating market scarcity rather than paying a direct dividend. Users benefit from the reduction in supply without receiving an unregistered security payout. The 70% burn proposal translates centralized corporate cash flow into a mathematically guaranteed supply contraction. Jupiter built a monopoly over a decentralized network, using aggressive acquisitions and integrated product layers. A private company domiciled in the British Virgin Islands maintains the software and captures hundreds of millions in fee revenue. That centralized authority is now testing whether a 70% buy and burn proposal can align the interests of its private entity with those of its public token holders.
Now, this really quick. This is what we're talking about when we talk about value accrual.
Exactly.
We talk about it with hype. It looks like Jupe it has put some measures in place that added, because before, from what it's saying, but before there was no value accrual. It was basically shit tokenomics. But they understood that, and they actually have made changes for now that they're having the buybacks and the burns, and they're trying to navigate the the legal gray area to make it to where there is value accrual for Jupe token holders. This, I see this being bullish moves and news for Jupe token holders.
Agreed. This is exactly what we look for.
Yeah.
Mint succeeds, it provides a functional model for institutional capital to interact with DAO governance within existing legal constraints. The future of the governance token model depends on whether this artificial value capture mechanism can effectively substitute for real corporate equity.
I think that the answer is yes. I think that it can. And let's just take a look at JUP, Jupiter, just the coin.
I need to buy a little bag of it.
Yeah, well, I mean, that was pretty interesting. So JUP, how about JUP USDT? I'm looking for a futures contract. Binance will work. I'm going to invert the scale, and then this is a daily. Okay, so this is JUP. Now, it was super inflationary because, when it launched, when the Jupiter exchange launched in 2024, I think they launched in 2024. It was right at the beginning of the last bull.
Yeah.
There were all these airdrops and, all this hype, all the meme coins. So the thing launched.
Same thing happened with Aster and hype and, all that stuff, whenever they first launched. It's just, you get that initial, kind of euphoria, that pump and dump.
Yeah, so it was the launch painted a flag, and the pattern confirmation, pretty nice. This is almost a perfect, breakout of this flag. But it's done nothing but, I mean, you could say that this is like a big, it's not really a big flag. This is like some type of triangle pattern. It's sitting at the 200-day moving average. And I mean, look, if they're still executing that buyback or burn program now, this one could be kind of interesting. For it to just get back up to trend line resistance, that's 51 cents. The only problem is that it's still a Bitcoin bear market, though.
Yeah.
So, yeah, we would really need to see Bitcoin, basically like bottom out in time and bottom out in price for me to feel more comfortable buying this one. But, Jupiter, I think it's jup.ag. I think. Yeah, that's the URL. And then if I'm just taking a look, so they got prediction markets now, you can swap. I mean, this is definitely, if you're going to swap, this is the place where you do it on Solana. And then, if we click on more, they've got, a pretty cool, if we go to onboard, you can bridge using dBridge over here. You can bridge using CCIP or CCTP. That's pretty cool. They've got a lend, a money market now.
Nice.
Where you can, this is super cool. And that JUP USD, that's composable. So you mint JUP USD, and then you're going to get a JL JUP USD, which then you can use in other DeFi strategies here.
Yeah.
So that's pretty cool. Yeah. This is pretty cool. Yeah, man. Athena and Bitwise.
What's the liquidity like? I'm sorry, you might have already looked at it, but what's the liquidity like on the platform?
Well, it's the greatest on Solana, I believe.
At 1.9 billion?
1.9. Total
Nice.
supplied. Yeah. Yeah. 1.12 total available. So pretty liquid over here.
Yeah.
Um, yeah, this is, and there's also, if we take a look at more, it's in perps. If we go to perps, and then when you trade perps on Jupiter, it's kind of expensive. So I would just keep that in mind, like in terms of fees. And what you're doing is you're trading against a pool. You're trading against JLP. So if you take a look at the JLP pool, holding the pool token makes you the counterparty to every trade on Jupiter. And just to hold the token, you earn 11.73%. The token is composed of 46% SOL, 7.46% ETH, 14.55% WBTC, and the remainder, 32%, is USDC. They
Solid
used to be US.
assets.
What's that?
I mean, for the most part, solid assets.
Oh yeah. No. You can do a lot of cool stuff with JLP. And then if you hop on over here to Delta Neutral, so you can lever up JLP. Unfortunately, right now the yield that you would earn doesn't look like it's greater than what you would pay to borrow against it, or at least not by enough.
So the interest rate arbitrage wouldn't work out.
It doesn't look like it's going to work out all that well here. Not right now anyway. But there have been plenty of times, last bull, I had like a JLP levered long open for 2 years that I forgot about. It was my best performing position, like in terms of just APY over a period of time.
Yeah.
So yeah, this is really cool though. Prediction markets, a money market, perps, this is the place to swap on Solana. And Terminal, not quite sure what Terminal is, but it looks like this is an intelligence market. So this is cool. I like Jupiter. I like JUP now that we know a little bit more about the value accrual mechanism. And I hope that Solana thrives. I really do. So yeah, Mike, I think that's about all the time we got for today. You want to take over the sticks and run through the socials?
Yeah, let me do that real quick. All right. So if you want to find us, obviously you can go to YouTube if you want to join the chat. And if you want to find us on YouTube, it's at the Node Network, all one word. But the best place to find everything that we offer is here on our official website. It's thenode.pro. So this is where you can find all the deep dives that we've gone over. Like you can see, we just went over Jupiter and Solana. So these will be removed from the featured on Monday. When we have new ones up, we'll be probably doing Hedera and one more. I got a that P2P protocol maybe. There's a whole deep library, all the different the controversial Kita network one that we did, Aerodrome, Cardano, Chainlink, Zcash, and a bunch of these. People can say what they want, but Zcash, the day before all that debauchery went down, we did a deep dive on it, pointing out some of the issues that we saw with it. Aave. I don't believe that we had the library yet when we did Aave, but we did a deep dive on Aave, and it was 2 weeks before October 10th, or no, not October 10th, but before the exploit.
It was April. It was April something, some date in April, I think.
But 2 weeks before, we were pointing out the issues with the pooled liquidity. And and a lot of the other issues with the the DAO leaving and the risk team leaving and the developers of V3 leaving and a lot of that, and it led to David pulling his life savings off of Aave 3 days before it would have gotten locked up there. And thankfully there was a lot of of the community that got together and was able to kind of bail out a lot of the people. And I still would like to take a closer look on if the most or all of the people that had liquidity on Aave was able to get their liquidity off. But that being said, these deep dives are very valuable. Can some of the information on them be wrong? Absolutely. We're not going to claim that everything we put out here is 100% correct. You can't be lazy. You have to do your due diligence, but these are very powerful to get a general idea of what the project is about, what pain point they are trying to address, what it is that they're trying to do to be a part of the future financial system, or maybe it's a wallet. We've done a couple on wallets. If they have no token at all, like Fireblocks or Securitize, but they're still playing a huge role, and it's good to understand the architecture of the future financial system, and potentially how you can find ways to indirectly profit from these projects. If you're bullish on Fireblocks, maybe you invest in protocols and and chains that are utilizing Fireblocks technology. Is why we're here. We're here to educate, but again, no cost. All you have to do is come in here and use it, and you might need to sign up for a no cost account, but you can use this, and it doesn't cost you anything. We give this away. It's name another channel out there that has this type of value that they just give away. The education, here on the main page, you start free now. Again, no cost. We have a whole DeFi university that teaches from beginner to advanced how to use wallets, how to use major DeFi protocols, what all of it means, all the different terminology, the Greeks, with delta neutral, and all of the things that pretty much every other channel out there charges hundreds, if not thousands or tens of thousands to teach you. We give away at no cost. We truly want to just educate you. We don't want to influence you. We want you to make your own decisions on what you want to invest in, even if we're not bullish on it. We just want to make sure that you're doing it in an educated fashion, that you are knowledgeable about the risks that you're taking using the protocols, investing in the tokens, whatever. I don't care what you do with your money. David doesn't care what you do with your money. It's none of our fucking business. Just like it's none of the government's business what we do with our money. We believe in being self-sovereign. It's that's our core principle here. So again, DeFi University, no cost. Intel Library, no cost. AI newsletter. You can do a no-cost trial and try this out and see the value that it has. And the cool thing with this is you pick the assets for the newsletter, whatever you're invested in or thinking of invested in. And it's not just crypto, it's stocks, it's commodities. So you select the asset you're interested in, you generate it, and it's going to give you news, it's going to give you trading ranges, it's going to give you everything that you need to know about those assets and why they're moving up or down, or give you the hottest news on what it is that's going on with those. Stuff that would take you an hour or two, possibly more, scouring online looking for, this will do for you in about 15 seconds. So, I mean, it's important to find tools like this. If you want to get it on a regular basis and have it delivered to your inbox, it's $20 a month, so like 66 cents a day. But what's your time worth? An hour or two of your time, is it worth 66 cents to get that hour or two back? For me, it is. The community, again, no cost. Our Discord, it's not gated. If come on in, join the Discord, ask questions. Me and David are always in there. Jeff's in there sometimes. Scotty D and a bunch of the other people from our community are all happy to answer questions and help out. Come on in, join the crew. There is one channel in there that is the premium Discord that allows you to join the Monday, Wednesday, and Friday live calls with David, where he gives live lessons on like a Zoom call or a Google Meet, and the rest of the community. So the other people that pay for that service, and they just sit in there and they all discuss different current DeFi opportunities that they're using and sharing how profitable they're being, or maybe if they lost money. Like, hey, I tried this out and it didn't work. It's a way to find a mentor. It's a way to maybe if you have an idea, you're like, hey, I was thinking about I put together kind of an advanced strategy, and I want to bounce it off all of you. What do you think of this? Is this a stupid idea? Is this a good idea? It's a great place to bounce ideas around. So again, just another service that we have. The store. If you want to support the store and you see a design in here that you like, by all means, buy a hoodie, buy a t-shirt, buy a hat. I mean, we appreciate the support. Not necessary, but we definitely appreciate it. If you come into here, you have Learn. Again, this is DeFi University. The programming. If you want to know when our shows are on, you can see it on YouTube on the different channels. But here is just a snapshot. So today we got David's Market Wrap at 1 p.m. Pacific, 4 p.m. Eastern. We have the live call I was just talking about, the paid live call. And then tonight, me and Jeff are doing Crypto and Chill, where we're just going to hang out, drink a beer and just talk about what's going on in crypto and talk about life. Coaching. After you go through DeFi University and you get spun up and or maybe you're already at a more advanced level and you want to take it to the next level. This is David's kind of bespoke one-on-one offering where you can come down here, put your email in, and schedule a no-cost consultation. He'll sit down with you, go over your risk profile, go over your portfolio, go over what it is you're trying to accomplish and where you're at in your journey. And if he feels like that you're ready to take that that step and get the max value out of that one-on-one time over like an 8-week or whatever time period, then you can decide if if you want to purchase that service and take your investing to the next level. And he has an API that he's working on. So if you're somebody out there that enjoys designing dApps or maybe some sort of tool for that require data streams, this is something that he put together that where it fetches data from multiple sources, on 300 different assets. So this is something that a prepackaged basically tool that you can use as a developer. So did I miss anything, David?
No, sir.
Awesome. All right. Well, we appreciate you and hope you join us for the wrap later on today, and then also for Crypto and Chill this evening. And until next time, Veteran Crypto out.
Peace.